Even wealthy Norway isn't immune to economic chills. In late 2024 and early 2025, the country's usually robust economy started to contract. Mainland GDP fell by 0.8% at the end of 2024, and another 0.5% in early 2025, clear signs of a shrinking economy. For a nation used to stability, this was a wake-up call. At the same time, borrowing costs soared as Norgesbank hiked its main interest rate to 4.75% to fight inflation. High rates made loans for homes and businesses much more expensive, slowing spending and investment. Norway's economic engine, long fueled by oil and gas, was sputtering. The overall GDP growth for 2024 was a mere 0.2%, and forecasts for 2025 predict a further 0.3% decline. This is a sharp contrast to the prosperity Norwegians are used to. Jobs are harder to find and prices remain stubbornly high. The government and central bank are working to manage the downturn, but solutions are complex. For many Norwegians, the economic weather has turned cold and uncertain. The resilience of the people and their institutions will be tested in the coming months. Understanding these changes is crucial for navigating the new landscape. Norway's leaders face tough choices as they try to balance growth, inflation, and stability. The country's economic strength is being challenged like never before. How Norway responds now will shape its future. The next chapters will reveal if Norway can weather this economic freeze. Norway's economic troubles can be summed up in 5 main challenges. First, GDP is falling. Businesses are producing less and people are earning less. Second, high interest rates make borrowing expensive for families and businesses, slowing down the economy even more. Third, inflation remains stubborn. Even as it eased from a peak of 6.5% to 4% by March 2025, it's still above target, squeezing household budgets. Fourth, unemployment is rising. The jobless rate climbed from 3.5% to 4.2% in just a year, making it harder for people to find work. Fifth, both investment and consumption have dropped. Household spending fell by 1.5% in 2024, and business investment dropped 3%. The construction sector was hit especially hard, with housing investment plunging 10%. These trends feed into each other, creating a cycle of lower growth and confidence. High interest rates and persistent inflation and job losses are straining Norway's social model. The government faces the challenge of supporting those most affected while not fueling inflation further. Businesses are cautious and families are tightening their belts. The drop in spending and investment reflects a lack of confidence in the future. Norway's economic engine is sputtering and the path to recovery is uncertain. Policymakers must break this cycle to restore growth. The stakes are high for Norway's prosperity and social stability. The coming months will test the country's ability to adapt. Can Norway turn these shadows into opportunities? Let's break down the numbers behind Norway's economic storm. Mainland GDP fell by 0.8% in late 2024 and another 0.5% in early 2025, a clear sign of slowdown. Annual growth for 2024 was just 0.2%, with a 0.3% contraction expected in 2025. The construction sector saw a 10% drop in housing investment, hit by high interest rates and rising costs. Manufacturing also struggled as demand weakened both at home and abroad. Oil and gas exports provided some cushion, but global price swings add uncertainty. Exports slowed, and imports stayed expensive due to inflation and a weaker krone. Business investment fell 3% and household consumption dropped 1.5%. People and companies are holding back. Inflation peaked at 6.5% and eased to 4% by March 2025, but core inflation remains high. Norgesbank kept interest rates at 4.75%, directly impacting jobs. Unemployment rose from 3.5% to 4.2% as companies cut back. The numbers tell a story of caution, contraction, and challenge. These numbers have real consequences for Norwegians. Young families like the Johanssons postponed buying homes as mortgage costs soared. Small businesses like Ingrid's Cafe in Bergen faced higher costs and fewer customers. High interest rates made loans unaffordable, forcing businesses to cut back or delay plans. The government responded with targeted support, boosting benefits for low-income households and offering energy subsidies. Norgesbank kept rates high to fight inflation despite the pain. The government tried to balance fiscal restraint with support for those hit hardest. Every decision is a trade-off in this new economic reality. High interest rates are at the heart of Norway's economic slowdown. By making borrowing expensive, Norgesbank aimed to cool inflation, but this also slowed growth and hurt jobs. As spending dropped, companies sold less and cut back on hiring. The construction sector, hit by a 10% drop in investment, saw job losses. Inflation, though down from its peak, still erodes real incomes and makes people cautious. The government collects less tax revenue as growth slows while demand for support rises. Norway's oil fund provides a buffer, but the government is careful not to overspend and worsen inflation. Every policy choice has ripple effects. Balancing support and restraint is key. The challenge is to fight inflation without deepening the downturn. Norway's leaders must navigate these trade-offs carefully: the stakes, jobs, stability, and the country's economic future. Steering Norway through this storm requires coordination between the central bank and government. Norgesbank raised rates to 4.75% to tame inflation, knowing it would slow growth and risk higher unemployment. Their goal? Bring inflation down to around 2% without causing a deep recession. The government tightened spending, limiting withdrawals from the oil fund to avoid fueling inflation. At the same time, they offered targeted support, temporary benefits, and energy subsidies to help those hit hardest. Both institutions face a delicate balancing act: support the economy without undermining price stability. Long-term investments in green energy and infrastructure continue, aiming to build future resilience. The challenge is to provide relief now without sacrificing fiscal health or future growth. Norway's economic management is being tested on all fronts. Success depends on smart, coordinated action. The outlook for Norway in 2025 is tough, but not hopeless. The economy is expected to contract by 0.3%, with high rates and cautious spending likely to persist. Unemployment may rise further if the slowdown deepens. Yet Norway's oil and gas revenues and its massive sovereign wealth fund provide a strong safety net. Inflation is slowly easing, which could eventually allow for lower interest rates and some relief. The government is focused on targeted support and long-term investments, especially in the green transition. Policymakers must balance short-term pain with long-term stability. The challenge: control inflation, support jobs, and avoid a deep recession. Norway's strong institutions and wealth offer hope for recovery. With patience and smart policy, the country can weather this storm and emerge stronger. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.